Conventional wisdom doesn't work. And you should train your mind to just question everything. When you look around you and you think about conventional, you pick one, just pick one. And then you ask yourself, okay, it's not working. Conventional education, go to college, get the degree, come out of college with that 6-figure job and drive the nice company car. Is that working? Not anymore. Conventional medicine, conventional health, conventional wealth. Work in this cubicle for 40 years, invest your money in a 401k, and someday you might be rich enough to retire and live the good life. How's that work? That's horrible. So just you go down the list and you ask the question about conventional in a lot of those different categories, and you ask yourself the question, does that work? How's that working for people? And you quickly realize that conventional wisdom usually isn't the best way to approach things.
Welcome to Elevate, the masterclass where we dissect the elements of exceptional achievement and lifestyle design with a focus on personal growth and real estate investing. Now, here's your host, Tyler Chesser.
Elevate Nation, welcome back. This is Tyler Chesser. I'm so thankful to have you here. And I am blessed and grateful to be sitting with Dave Zook today. Oh, baby. We covered tremendous ground in today's episode. And you are going to learn what it means to explode conventional wisdom, what upside there is in expanding your future through questioning conventional wisdom. Ultimately, you can be conventional or you can be wealthy. Pick one. Today is going to give you the opportunity to expand your wealth, not only from a financial perspective, from a tax mitigation perspective, but also to expand your lifetime fulfillment through questioning conventional wisdom across the board in your life. I'm telling you, today's episode is life-changing. And oh, baby, buckle up. Elevate Podcast is all about mindset, mind expansion, and personal development for high-performing real estate investors. I'm your host, Tyler Chesser, and I'm a professional real estate investor and entrepreneur. It is my job to decode the stories, habits, and multifaceted expertise of world-class investors and other experts to help you elevate your performance and lifestyle. Are you ready to take it to another level? It is time. Let's raise the bar today. And before we dive into this episode, I want to invite you to pay the fee. The fee is to pay it forward and share this episode with a friend. Just grab the link wherever you're watching or listening to this podcast. All you have to do is grab that link, shoot it forward via text message, email, social media, post it. Just mention the podcast to someone else. We just really ask you to do that from the bottom of my heart. I really appreciate any introductions. I know that referrals, we don't take them lightly, and we want to add value to other people in your community. The only way that we can continue to grow and add value is if you help us share this episode. If you've done that in the past, we just want to thank you. I'm here to thank you today. We ask you to do that once again today. That's the fee for listening. Otherwise, it's 100% for free. And then also, by the way, if it's your first time listening to Elevate, welcome. We're here to pour massive value into you. And again, these episodes, we put in so much work, time, attention, because we want to show you massive respect and kudos to you for giving us your time and attention today. And without further ado, I want to introduce you to the man, the myth, the legend, Dave Zook, who is the founder and CEO at the Real Asset Investors and the owner at Horizon Structures. Dave Zook is a tremendously successful real estate investor and alternative investment syndicator-operator who's provided tremendous value for thousands of investors. He's raised over $500 million for alternative investments. He has transformed his own tax liability, a sort of lifestyle in such a big way. And he's helped over $100 million worth of other tax liabilities be erased for other investors. And it's not just about letting the tax tail wag the dog, but it is about creating a lifestyle, and it's about expanding through the clues of what Dave has shared with us today. So without further ado, please enjoy this fantastic, this insightful, this inspiring conversation with Dave Zook. Welcome to Elevate, Dave Zook. How are you, my friend?
I'm good. Tyler, thanks for having me on the show.
Absolutely, man. I'm excited about this, and it was fun to just kind of catch up here before we got going. And we got a Friday morning, we got Friday energy, and I was looking back on my week and I'm like, oh, I still have about 27 things I need to accomplish. It sounds like the same for you, and that's a typical week, right? But while we dive into this conversation, Dave, why don't you take a moment to Briefly introduce yourself to Elevate Nation. Talk a little bit about your upbringing, a bit about your backstory, if you don't mind.
Yeah. So fortunately, I was born and raised in a very entrepreneurial, business-friendly family, and I grew up in the family business, which was modular buildings. We were building modular buildings, still are. My dad bought the business the year I was born. And so I sort of grew up in that space. And as I was getting into my teens and early 20s, I was kind of looking around, seeing what else is out there. And I started investing and building some businesses, largely due to the fact that I saw my dad investing his extra money. He was very successful, is very successful. And I seen him investing his money in farms and land and some single family homes. And I saw him self-manage those single family homes. And I quickly lost appetite and for anything that had to do with investing in real estate. And I just decided that wasn't going to be me. And so I started building businesses, and long story short, some of those businesses started doing really well. Got myself in a position where I was paying $500,000 a year in tax. And I was having a lot of fun at the time building these businesses and running the businesses. But when I had to give half my money back to the government, or almost half, it just wasn't so much fun anymore. So that's what drove me into investing first in multifamily apartments and, get familiar with words like cost segregation studies and 100% bonus depreciation, Section 179 at the time, and quickly took my tax liability from $500,000 a year to zero the following year. So really studied and got my mind around how that worked. And eventually got to the point where I realized there was a lot of people sort of in that camp, and I started teaching it. And so I sort of went down that path of investing in multifamily apartments. That led me down to the path of bringing some friends and family with me, and then kind of business associates and all that. We started doing some deals together, and next thing you know, I'm a syndicator. Really didn't plan it that way.
Yeah, man. I know that so many of the listeners can resonate with what you're talking about, and myself included. I remember those first few sort of big tax checks I had to write to the government. I was like, man, that does not feel good. And it pushes you into action. It's like it causes you to start asking questions and sort of the conventional wisdom as well. I remember hearing this, and I'm sure you've heard this yourself. It's the CPA that says, well, if you're paying more taxes, that's a good thing. That means you're making more money. And I love your tagline. It says, you can be conventional or you can be wealthy. Pick one. And so is that where that sort of line of thinking began?
Yeah. I mean, Tom Wheelwright shared with me more than a decade ago. He said, if you want to change your tax, you got to change your facts. You got to change the way that you're doing business and the way that you're investing. And I always succumb to the conventional wisdom is if you make a lot of money, you got to pay a lot of tax. That's what I was taught. That's what the influence I was under, including my then CPA. Well, you had a good year. What do you got to do? You can make less money or you can pay a lot of tax. That was sort of the thought. So the idea that I could control, that I could make a lot of money, but control my own tax liability never occurred to me until just over a decade ago. And when I realized that was in my control to reduce my tax liability, everything changed.
Yeah. And it's not how much you make, but it's what you keep, right? I mean, I think that's the realization that most business owners recognize over time. After you start writing some checks that are like, man, let's question that. And it doesn't feel good to fork over a significant percentage of your net profit. You start to look for opportunities to change your facts. So how long did it take you to really take action and really pivot the way that you interacted with your tax strategy? I mean, was that, all right, 1 year later, it was completely transformed, or was it over a few years or so?
Yeah, good question. So I went from paying $500,000 a year in tax 1 year to zero the next year.
That's amazing.
And it's been close to zero ever since.
And the primary mechanism was through cost segregation, depreciation, and so forth, or give us a sense of what else you were able to change your facts, so to speak.
Yeah, that's really what it is. I had a conversation with an investor the other day, and that investor was telling me how he's put this whole entity structure and using trusts and entities and offshore stuff and moving stuff around. I was like, for one, that sounds complicated and it's expensive to maintain. And unless you're immersed in that stuff, I mean, for me, I get lost in all those details. Like you got to structure different things, different ways. Much more simple than that. You really take your income, and this is what we teach. This is what I do for myself. There's really three kinds of income. That's more than that. But the top three are ordinary income. You got passive income. You got capital gains income. Of course, there's portfolio income, there's short-term, long-term, whatever. But those are kind of the three that most people are familiar with and that you should make sure you got your head around. And then really what you're doing is you're taking an asset class that provides the depreciation to go along with that stream of income to wipe out the tax liability on that stream of income. And so for passive income, there's just tons of ways you can offset the tax liability on passive income. For ordinary income, if you're a W-2 guy, if you're a doctor, a dentist, a lawyer, a high income earner, it's much harder, but it's still possible. There are asset classes out there. And you really, when it comes down to it, you really got to figure out what does the government want you to invest in, right? And then so then you got to find that asset class to offset tax liability on your W-2 income. And there's some out there. There's some good ones out there, especially now. And so really just taking those asset classes that give you the depreciation that you need to offset the tax liability on that income, capital gains is another easy one. So really the hardest one is that W-2 income earner, but there's options for that. And so that's what we do for myself. And that's what I teach people to do.
Yeah, it's so valuable. And a couple of resources for the listeners who want to dive deeper into this. Maybe they find themselves in that position where they've got tremendous earned income and they're getting taxed at a significant rate. I mean, obviously looking at Robert Kiyosaki and what he's taught over the years in terms of the cash flow quadrant and how you can make leaps from one part of the quadrant to another. And then, of course, you mentioned Tom Wheelwright earlier, thinking about tax-free wealth and what he writes about and what he educates about. If you think about the IRS tax code, at the end of the day, it is all about incentivizing certain behavior. So understand, what does Uncle Sam want to partner with individuals and businesses and investors on? And it can help you guide your behavior. And it's not like you, and I would imagine looking back, in many regards, obviously you were pushed into action to make a shift in terms of how you were spending your time, how you were creating value. It's not like the tax tail totally wagged the dog, but it pushed you in tremendous forward progress into action. And so now the real asset investor has become a pretty substantial thing, and you've scaled in a massive way. You've helped so many others access real assets and alternative investments through sort of this initial push. So talk to me a little bit about those alternative assets. And you mentioned you started kind of in the apartment space and multifamily, but you've done so many other asset classes. Could you talk a little bit about that?
Yeah. So to your point about finding out and using the tax code to your advantage, I always sort of shock people when I tell them this, because it flips on its head the thought that if you make a lot of money, you got to pay a lot of tax. People think it's patriotic to pay a lot of tax. Who would build the roads, right? Well, if you want to be patriotic, do what the government wants you to do and pay zero tax. They'll pay you to do it. And so, it kind of flips people on its head when I tell them, or it flips that whole thing on its head when I tell them that really, when you end up the year with a big tax bill, that's the government punishing you for not doing what they want you to do. That's a fine. That's a fine for not doing. That's like a citation. That's a fine for not doing what the government wants you to do. And when it all comes down to it, when you add value to people, when you add value to society, the government rewards you for that. When you provide housing, when you provide energy, gas, oil, anytime you're out there providing a lot of value through jobs, buying new equipment, stimulating the economy. All those things is what the government wants you to do. And if you do it, and you do it well, they'll pay you to do it. And so different asset classes, to your question, some of the asset classes that we're involved in, our three core asset classes, self-storage. We do a lot of self-storage. We do a lot of ATMs. We're one of the top 4 ATM operators in the country. So if you see an ATM and convenience store out there, there's probably a 1 in 4 chance that it's ours, maybe a little less, but it's a good chance they might be one of ours. And then we're building and acquiring Tommy's Express car washes. So those are sort of our core asset classes. A quick story on several of them. We just rolled up almost a year ago. Back in November, we rolled up 26 of our self-storage properties, sold them to a REIT out of Chicago. It was a $450 million deal. It netted our investors around a 31% cash on cash return annualized. And so that was a great deal for us. So we have a great operations team and we do a lot of self-storage. On the ATM side, another great asset class, but it's almost like when you look at diversification, you look at those two asset classes and you think, that's just like opposite. The one is super strong cash flow, 100% bonus depreciation in year one, but then there's no equity. You get out to this to the end of the 7-year period and the deal's over. Self-storage, our business model is we buy it from a mom and pop operator. We add value, we force value into that deal. Normally, a lot of times we're adding square footage, climate controlled square footage. We know what the REITs want. We've sold 40 plus properties to REITs, so we know what they want. We're adding climate controlled units. Many times we're taking a 50,000 square foot facility and turning it into an 80,000 square foot facility. And then we're stabilizing it and sell it to a REIT for some crazy cap rate. A lot of margin in that business, but it's it's almost opposite in that because we're adding value and spending money in the property, whatever, pretty modest cash flow, also fairly modest tax impact, but then we've seen huge equity upside and we made money at the exit. And so just to be able to provide those different sort of asset classes with the different attributes for an investor, like if I have an investor coming to me saying, hey, I sold a property and I've got $500,000 in gains, what would you suggest that I invest in? Well, okay, that's different than somebody who says, hey, I'm a doctor and I made $500,000 a year in income or $1 million a year in income. What do you got that I could invest in? I mean, those are conversation starters. And then, my suggestion is always, well, let's look at big picture. Where are you at your tax on the tax side? And then what are you thinking about cash flow or equity growth? Because some people think, many people think, okay, I'll put $100,000 out there. I'm going to put $500,000 out there and I want that money to earn money, right? But many times, if you can if you can reduce your tax liability, you can knock out that 37% tax. That's a 37% return on investment first year, right? So it's those kind of things that we talk through, and that kind of stuff gets me excited. I love helping people walk through their tax liabilities and really ultimately their wealth strategy.
That's fun, man. It is a game, to your point. It is a fun thing to kind of put those pieces and that puzzle together. So thinking about those three different asset classes, when you think of self-storage, ATMs, car washes, which you mentioned are the three main asset classes that you've been focusing on recently over the past few years. And when you think about those three different components of the asset classes, you mentioned self-storage and the margin, the profitability in terms of that strategy that you guys have successfully employed. Now, how do ATMs and car washes play into that overall strategy? You mentioned sort of a tax strategy, maybe a profitability for one asset class. Maybe give us a sense of what ATMs and car washes, what role they play in that portfolio overall.
Yeah. So car wash and the other one is when you understand the business, you realize that, the margins, it's a cash flow investment. It's a cash flow investment, number one. The other thing is institutions right now are all over it. It's like they understand that several things. They understand it's a very high cash flow business. They also understand that since spring of 2020, it's kind of a big deal when you can take a team of a business normally that size, that many transactions, that kind of volume passing through your business. You're thinking 12, 15, 20, 50 employees. Here, we can run 200 to 300 cars per hour through our tunnel and get their cars washed. And, you can do that with 2 employees. And so they recognize that this thing about hiring and retaining good people, that's become a lot harder than the last 2 or 3 years. And so to be able to run those kind of margins, 45% margins on EBITDA and doing that kind of volume with 2 people, and then also recognizing sort of like the self-storage space where this business is a proven business, even during a recession or pullback. So you're looking at that thinking those 3 key ingredients are very popular with investors, but institutions have been waking up to the fact too, and they're seeing this and they want it. So there's incredible appetite in the institutional community for car washes. And we're really building this thing to sell right now, we started out thinking that we're going to build 30 to 40 car washes in 5 years. And we're on pace to build 60 in 4. And so it's really a race to really assemble a big package of car washes and at some point exit to a reader or an institution. And what we've seen is car wash packages trade when there's 8 to 10 car washes in a package. We've seen those trade at somewhere around a 10x multiple. But we've seen once you get it to the size and scale where it's an institutional grade package where there's 20 plus car washes will last, or institutional size packages with 20 plus car washes and well-run tunnel washes. But we've seen those trade around the 20x multiple. And so just lately, the last couple of weeks ago, an article came out in the Wall Street Journal that really confirmed that. And they're talking about those multiples, 18 to 20x multiples on large institutional grade or institutional size portfolios. So we're really building this portfolio to at some point exit to reap down the road sometime.
That's very exciting. It makes me think back to my very first job was at a car wash, and we did not have 2 people. We probably had 12 or 13 or whatever. But, obviously that industry has really been transformed. It's really interesting when you go. I mean, it is totally a machine in every aspect, in a money printing machine in many regards. So that's exciting to hear the scale that you guys have been able to achieve and the opportunities that you're uncovering in that space. And with regard to ATMs, I mean, help me understand the functionality that asset plays in the overall portfolio as well.
Yeah, so that's a very aggressive cash flow play. It's 24.5% cash on cash return with an IRR of around 19%. And so when you look at what it is, the business model is very simple. I mean, somebody comes and swipes their card, costs them around $3. Someone on the other side of that transaction is getting the $3, right? So we take down large portfolios, institutional grade locations, convenience stores, delis, those kind of locations, high foot traffic locations in the right communities. We're taking down those large portfolios, could be $5, $10, $20 million portfolios. And instead of getting them funded by Wall Street, we're bringing that portfolio down to our investor community and we're funding them privately. And so normally in the space, you typically have either one of two. You have a mom and pop operator that's running around, can service up to 150 machines, 150-ish machines in a 50-mile radius until they've kind of capped out. It can be a very lucrative business, but it's also a very active business. It's not very scalable. And so on the other side of the spectrum, you have the Cardtronics of the world, the big four, the big three, publicly traded companies, billion-dollar revenue companies, and they're all of their maintenance people, their operators, their St. Loomis bringing in the cash, bill of the machine, all third-party auditors. You can imagine there's cameras everywhere. And so you sort of have those two players, mom and pop and institutions. We're somewhere in the middle. We take down large institutional grade portfolios, like over here with the big players, but then we bring them back over to our investors and we fund them privately. And then, of course, we manage that portfolio for the investor. An investor coming in will invest $104,000 for a unit of ATMs for accredited investors only. That unit of ATMs gets placed in the portfolio, and then that investor gets paid on the blended performance of the entire portfolio. So his ATM machines are in the portfolio, but he gets paid based on the entire portfolio. So if you're in Naples, Florida, it's your 6 ATM machines are in Naples, Florida, and you get wiped out. Unfortunately, they had some rough weather down there the last couple of days. Your cash flow doesn't stop because your ATMs are underwater. You've got a blended portfolio across the fund, and you're getting exposure to maybe 1,000 or 2 ATMs in the fund. So you get paid right now. We're paying out $2,142 per month. It's a 7-year contract for 84 months. And it's a very aggressive cash flow plan. It's a 100% bonus depreciation in year one.
That's awesome. Yeah. And let's take it to a step sort of higher and to get a step back and kind of looking at the overall strategy. I mean, from a pace of growth, obviously looking back, I mean, you mentioned the word scalable. I mean, you've scaled significantly from a capital raising perspective. And obviously you speak the language of business owners and people who have gone through some challenging sort of tax experiences themselves. And obviously I'm sure you resonate with them, but I want to get to capital raising and sort of the mindset behind raising $500 million plus from investors and offering those type of opportunities at scale. But before we get there, talk a little bit about your strategy when it comes to finding these opportunities that you're just speaking about in various different real assets. I mean, are you doing JVs? Are you doing fund to funds? Are you partnering with operators? Are you guys sourcing the deals and vertically integrated yourself? Or help us understand a little bit behind the scenes there.
So what we do well is we like to partner with the operator. So we like to be a funding partner, coming in beside them, consulting, helping them in ways to scale the business. We find a really good operator. I'll give you an example of our self-storage operator. 40 years in the business. I asked, when we first got to sort of know each other and I was asking him a lot of questions, I was asking him, like, what else do you invest in? And 40 years in business, very successful in the self-storage space. He was like, well, nothing. Self-storage is all I know. So that's a good example of we like to come alongside those people. Another example is the ATM space. I was a passive investor in the ATM space for about 4 years until I got the opportunity to partner with the guys. At that point, it was kind of a small friends and family fund, and got the opportunity to get in there and saw the opportunity to scale. In 2016, I became a partner in the fund and took it from that small friends and family fund to now one of the top 4 ATM operators in the country. So we like to get behind somebody that's kind of a master at their space, and then partner with them, come alongside them, help them scale the business.
Yeah, partnerships are so powerful. And one of the things that you've been able to do is obviously you've scaled the ability to partner with other investors through syndication. And so let's talk a little bit about raising $500 million. I mean, first of all, that is remarkable. I mean, I know we had a deal recently where we raised $16.5 million in the course of 2 months. And that was a big lift. I mean, but to be able to multiply that in the capacity that you've been able to do is remarkable. It's unbelievable. So talk a little bit about sort of maybe advice that you might give your younger self when you started raising capital versus where you are now. I mean, I'm sure there's been many lessons learned, many pitfalls to avoid, many things that have significantly worked well in terms of being able to be successful in this space. So talk a little bit about that.
Well, first, congratulations on your raise.
Thank you.
$16 million in 2 months is no joke, and I can appreciate that. So congratulations. But no,
Thanks, man.
Just going to market. And this doesn't matter if you're a syndicator, if you're trying to raise capital, if you're building a widget, if you're whatever, going to market, looking to add value, deliver a lot of value to a lot of people. That could be the fastest way to success. And one of the things that really helped me to kind of jumpstart and get a really good start on syndication was I was immersed in the investment world. I was doing a lot of this stuff on my own. I was investing, like I shared, I was investing in ATMs for 4 years before I brought it to my investor group. I owned several hundred apartment units before I ran out of my own money and then had to go find a way to get the next deal done. And that's when I got friends and family involved. And so really just being able to share a story and be able to say, look, this is what we're doing. This is how it works. This is how it works from the tax side. That's how it works from the equity side, the cash flow side, and really just showing them this is how this could work for you. And then going to market, looking to solve problems for them. A lot of those guys had the same problem that I had, heavy taxpayer, thinking that, well, I made a lot of money last year. I'm going to pay a lot of tax. And then I come along and kind of show them that, look, you have options. You got more options than that. And so just being able to go out in the community and creating value for people, when people realize that, when your investor realizes that you're looking out for their best interest, not yours. And, look, there's the temptation is there when you got a deadline to meet and whatever, the self-storage bit, you got a big deal that you're closing on. And you got an investor that comes to you that had a big liquidity event. He's just sold his business for $20 million. And he's looking to place capital. And you're kind of caught up over here on the ATM side where you got lots of depreciation, but you got this big deal that you're trying to get done over in the self-storage side. You never want to take an investor's money somewhere where it's not serving his needs the best. And so when investors realize that and they can trust you that you're looking out for them and their needs, that's a big deal.
I completely agree. I've found that myself, just a simple phrase of, hey, you know what? It seems like this deal is not the best fit for you, can be one of the most powerful investments into a relationship that pays massive dividends down the line. It's like, hey, look, I'd love for you to invest in my deal, but based on what we talked about, this just doesn't make sense. And here's why I don't feel like this is your best option. That is just like an opportunity to earn that type of trust and that type of relationship for the long haul. And in my opinion, I would imagine that's been a huge component of your success. And I think it's almost an investment, not only in the trust and the confidence that, hey, this person is wanting to truly add value to me and they're not just looking to close me out as an investor. But it's also a bit of a sort of a nudge towards the psychology of capital raising. There's a lot to be said about the psychology and the comfort level that people have by placing hundreds of thousands or millions of dollars with you. So maybe you could talk a little bit about your perspective and some of the psychology that you've uncovered through capital raising as well. Is there anything that you found to be interesting or any patterns that you've observed through raising capital over the years?
Yeah, I mean, and to your point, it is when you make those kind of calls, you're thinking long-term, not short-term.
Yep.
Like, could you benefit from putting on some good sales talk and getting that deal done and use that aggressive capital to get that deal done? Probably, but that stuff will come back to haunt you. And this business is about relationships. This business is about thinking long-term. And so when you can think long-term, it's sort of the difference between hunting and farming. The hunter is going to go out, catch or kill something, and he's got enough to eat for the day. A farmer just preps the soil, just thinks long term, just does what he needs to do, plants the soil, whatever, and eventually that bears fruit for a long time, depending on what you're planting. So it's that difference between the farmer and the hunter mentality. And this business, again, is about relationships and thinking long term. If you want to get momentum, you got to think long term. You got to do what's best for your investment.
Totally agree. And there is this tendency, it's like our mind tells us, well, you know what, this will be good for them if we just kind of fit them into this one size fits all box. But if we can fight against that, because that's the lower level self that says, hey, look, if we close them, we can win in the short term and then we'll figure out a way to win in the long term. I think you're setting yourself up for failure. And so to that point of having the mindset of a farmer rather than a hunter reaps tremendous benefits. And there's this compound interest of relationships and building and strengthening trust and playing the long game. It's like if some people, it's like on the other side of the fence, it's you can win a short-term battle, but you lose the war. So like, let's play to win the war. Let's till the land and let's really water the seeds of these relationships. Hey guys, just a quick word from our sponsor, then we'll be right back to the show. This episode of Elevate is brought to you by CF Capital, a national real estate investment firm founded by myself and my business partner, Brian Flaherty. CF Capital's mission is to provide property investment and asset management solutions to help investors like you maximize their returns by investing in high-value multifamily communities. If you are looking for risk-adjusted alternative investments in quality apartment communities, are seeking tax-optimized cash flow with appreciation upside without all the hassles of management, you might benefit from learning more about investing alongside our team. You're invited to reach out and learn more about how you can invest with us by visiting cfcapllc.com. We're also currently offering a free ebook called The Bottom Line, 10 Ways to Increase Cash Flow in an Apartment Complex. Whether you're a new or experienced investor, we're confident you'll find massive value in this resource. So go get your free copy today at cfcapllc.com. And now, please enjoy the rest of the show. Talk to me about your mindset. I want to talk a little bit about sort of the mindset that you've had, because you've obviously transformed sort of your activities from a business perspective to an investor, now adding value at scale to more people. But talk to me a little bit about the mindset that you've had to really kind of step into as you've transformed. I mean, again, going back to I love this tagline, you can be conventional or you can be wealthy, pick one. Maybe that's where we would like to take this in terms of just willing to question conventional wisdom. Or is there anything else that you might say that has been a mindset or a perspective that's been critical for you to adopt?
Yeah. So I shared it with a seniors class in our local high school yesterday morning. And we talked about that. And I told them, look, conventional wisdom doesn't work. And you should train your mind to just question everything. When you look around you and you think about conventional, you pick one, just pick one. And then you ask yourself, okay, it's not working. Conventional education, go to college, get the degree, come out of college with that 6-figure job and drive the nice company car. Is that working? Not anymore. Conventional medicine, conventional health, conventional wealth, work in this cubicle for 40 years, invest your money in a 401k, and someday you might be rich enough to retire and live the good life. How's that work? That's horrible. So just you go down the list and you ask the question about conventional in a lot of those different categories, and you ask yourself the question, does that work? How's that working for people? And you quickly realize that conventional wisdom usually isn't the best way to approach things. So really just questioning everything, not trusting conventional media. How's that? Yeah, it is horrible. So just training your mind to think when you see something that even you get caught up doing conventional, doing that whole same thing that 90% of the others are doing. And then you ask yourself the question, okay, how could I do this different? Because at the end of the day, conventional is not going to get you there.
It is really interesting when you go down that rabbit hole of the path of all of the different conventional thinking or conventional wisdom across media, across education, health, fitness, money, investing, career. I mean, like the list goes on and on, leading your family, relationships. I mean, like, honestly, we could probably have a 3-hour conversation on just this, but it is interesting. And when I think about Earl Nightingale, one of the all-time greatest personal development gurus, he was talking about The Strangest Secret in the World. He said this is not exactly what he said, but this is the concept, is the biggest indicator of failure is conformity. And ultimately, that's what you're talking about. It's like being a sheep. It's following in line. It's not questioning, why the hell are we doing this? Why the hell has this been done? It was like, well, it's been done for 200 years. It's like, okay, well, why? Is that getting us what we want? And what kind of outcome are we focused on? And if we're willing to question that and open our mind to consider a new path, well, then maybe we get to the outcomes that we want. And so when we start to question, then we can say, well, wait a minute, where do I actually want to go rather than, is that the path? Because sometimes we're focused on doing rather than gaining or the outcome. Does that resonate with you, Dave?
Yeah. And the other thing that I would say there is when you want to, one of the things that I did when I first realized that it was in my control to eliminate or reduce my tax liability, that I could make a lot of money, make millions of dollars a year, pay no tax. That was a new thought. So when I realized that could be done, then the next question was, okay, how can I do that? And taking the step to really hunt down the people that were teaching it, getting in front of them, getting in front of Robert Kiyosaki and asking him and his CPA questions about, okay, how is this possible? I was taught this way, but you guys are teaching something totally different. Like, how's that legal? How's that possible? And just then going to the people, like my story with the self-storage guys. Instead of me spending the next 5 or 10 years trying to figure out the self-storage space and really immersing myself in that asset class, big giant shortcut when I can come right around and team up or partner with somebody that's immersed in that space, somebody that's done it really well, and we can do business together. So really just kind of shortcutting that whole process and asking the professionals, tapping into the professionals. And so that's been a lot of fun over the years to really just, finding that professional team that really has their one thing and being able to come alongside them, partner with them, take them to the next level. They take us to the next level, and it's still not fun.
I love it. And it's just amazing. I'm just sitting here reflecting on just the absolute power of questions. The first realization is, hey, it is possible, right? It is possible for me to reduce my tax burden. It is possible to reduce it to zero. Or it is possible for fill in the blank, right? Anything. And my firm belief, my core belief is that really anything is possible. Obviously, a lot of things we just kind of limit ourselves to say, well, I have never seen that be done in my own sphere, or so it just can't be done. So I think we've got to start there and recognize, to your point, hey, anything is possible. And then number two, it's the question of how can I? And so it's just amazing to me, like some of these things that seem insignificant, just like questions, that puts us then in the world of possibilities to start finding the answers. And 80% of our success really comes down to our own psychology and our perspective, because if we don't ask ourselves those questions, we're never going to gain the strategy and the implementation opportunity to be able to do that. And so as you've continued to stack on these type of questions, obviously you're looking on the landscape, you're looking for opportunities, whether it's strategies from a tax perspective, whether it's acquisitions from an investment perspective, so on and so forth. Obviously, you're probably asking questions like many of us are, is like, hey, well, what is this market cycle actually going to shake out to look like? So I'd be curious, your take. Give us a sense of how you're viewing this market, how you're looking at sort of the economic crosswinds. How are you reading this environment?
Yeah, so it's interesting when I hear these conversations from apartment investors. They're talking about a 3/4 point rate hike that kills their deal. And to me, those numbers are too tight. There's really a margin there for me. But when we went through the spring, summer of 2020 with our ATM portfolio, our transaction volume for 2 or 3 months. At the very lowest point, our transaction volume dropped 11%. And so that 11% is a lot. But fortunately, we had a 28% margin buffer built in to protect our investors. And so you're looking at a 28% margin buffer. So I sort of just chuckle a little bit when I hear an affirmative investor, their deal gets killed because of a half point or a 3/4 point rate hike. When you look at the ATM business, the car wash business, you're looking at a business model, a well-run tall car wash that's running on a 45% margin on EBITDA. And when you look at what happened in 2008 to 2010, at the worst point during that era, car washes volume across the board dropped around 5%. So just a lot of margin there. So when you ask me the question about what am I seeing out there, investors beware, especially if you're operating under those sort of asset classes where you've got a really skinny margin that you're dealing with and don't have much protection.
I think it's critical to understand margin and to understand resiliency and to stress test your deals. I mean, the past 14 years have been a run up in most all asset classes. And so the people look back and the conventional wisdom in the investment industry comes to be, well, things always continue to grow. I mean, rent growth and velocity and all of these different things, it just grows. That's just the world that we live in. And man, we forget very quickly about these cycles. And guess what? What goes up must come down. So are there any tips that you might have to investors in being more sort of thoughtful in how they're investing with margin in their deals? Or is there anything in particular you would point to?
Yeah, I mean, it's hard today to find an asset that is providing good, steady cash flow and to buy that asset at a fair price. It's hard. Those asset prices have climbed, last you mentioned, a lot. So being able to go in there, force value into something, figuring out a need in the marketplace and forcing the value. One of the things that we're doing is in the car wash space is we're taking a very good location and we're building a car wash on it. So we're creating the value. We're forcing the value into that location by building a very profitable business on top of that. It's different than when you go out and try to buy something that's already providing steady, stable, solid income. There's a lot more competition for that type of a deal. So just realizing where the margin is and asking yourself the question, now, can I go out and force value into something, into a deal? I gave the example of taking a self-storage facility that's in an underserved area, taking a mom and pop operated facility and then adding the square footage and getting it up to the size and scale that's now attractive to our REIT. There's a lot of margin there. And if you go out and try to buy a 75,000 square foot facility that's got strong NOI, great cash flow, those cap rates are crazy low. And so just being aware and being able to recognize, okay, where is an area that I can force value? Because that's where you're going to make margin in today's market.
Where are you seeing the biggest opportunities in this next recession? I mean, is there any part of the marketplace where you see an opportunity to add more value than others or anything else that you're paying attention to closest?
Either having cash to be able to take advantage of opportunities that come along because of the market cycle. And those opportunities could be a result of a lot of things. Could be a result of over leverage. Could be a result of bad management. It could be a lot of things. But then being able to have either the cash or the ability to raise the cash to take advantage of those opportunities when they come along, I would say that would be a big one over the next 2 years.
Couldn't agree more, man. Could not agree more. And man, Dave, this has been a lot of fun. It's really fun to kind of dive into your mind and the way that you're looking at things and the way that you just question all of these things across society that have just been set in stone as this is just the way it's done. You always think about old time corporations like, well, why are we doing this? Well, this is how we do it. This is how it's always been done. This is how it's going to continue to be done. But I just appreciate the way that you, like the foundation of who you are is you're asking that type of question. It's like, well, why are we doing it this way? And can it be done in a totally different way? And also the other side is, how can I add value to other people How can I add value at scale to other people through your investor community? And then also it's like, how can we force appreciation? How can we add value to these investments into the community that we're investing in so that we can reap sort of margin and give ourselves more resiliency? So those are some of the summarizing comments that I would like to add. But Dave, I'd like to transition into the rapid fire section of the podcast. It's called the Rare Air Questionnaire. It's all about being uncommon. I mean, at the end of the day, this conversation has been so uncommon in so many ways. So I'd love to ask you just a few questions. If you had to point to 2 or 3 of the most impactful books that you've read over the past few years, what would those be and why?
Rich Dad Poor Dad is one. The Compound Effect by Darren Hardy is another one. There's another one that I read this recently, the Who Not How was a big one.
Yeah.
So I'm saying probably those 3.
Man, I love all 3 of those books. We'll put links in the show notes as to where the listeners can find those themselves. Of course, starting with a classic. I mean, that was one that almost put me in this world of questioning everything, was Rich Dad, Poor Dad. And then, of course, I mean, what we're talking about making investments in investors and other partners and relationships. That, to me, the compound effect is one component of that. And of course, there's so many different efforts that we can put forth that compounds, that give us exponential growth opportunities. And of course, man, Who Not How. I mean, that was a game changer for me as well. I mean, I grew up middle class, and our mindset that we were taught, the conventional wisdom in that sort of world, is if it is to be, it's up to me. And yes, there's value in our efforts and things like that. But ultimately, there are other people who can help us achieve certain outcomes and many more outcomes and achieve greater outcomes. So thank you for those reminders, man. I love that. And aside from what we've already talked about today, Dave, what's the biggest way that you elevate your life on a daily basis?
And you can put emphasis on health and wellness. Look, if you're, and I guess it comes down to the question, okay, what is wealth? If you're a billionaire and you're not feeling well and you're just unhealthy, and or if you're a billionaire and you're not, your relationships are in shambles and you don't have friends, are you rich? Not really. I mean, you got money, but so when I look at success and wealth, I think about those things. I think about it when we talk many times when we think about success and wealth, our mind naturally goes to how much money is in our bank account. But when you talk about real success and real wealth, it's much deeper than that. In fact, money might be top 3 or top 4 in that list. So being able to build relationships, being able to take care of your body, you only get one. If you don't feel good, nothing else matters, right?
So true, man.
Taking care of your body, your spiritual health, and then making sure you're sound financially and doing good deals and lifting people around you through doing that.
Man, I love that you're setting that type of example, because I think a lot of times investors get tunnel vision, and it's like, hey, it's cash on cash. It's internal rate of return. It's getting that tax bill to 0. It's all of these things. It's net worth. It's all these cash flow, blah, 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 on and on. But at the end of the day, success without fulfillment is the ultimate failure. And it comes down to health physically. It comes down to health in your relationships with your family, all of those things. And so I just appreciate the fact that you're giving us an example to course correct if for some reason we're out of alignment in certain areas of our life. Look, let's look back and say, man, it's not just about money. It's about creating a life. It's about investing in other people. It's about investing in your fulfillment. And I love that. So Dave, talk to me about the biggest way you elevate others around you.
Biggest way I elevate others around me, I would say from a financial perspective, we've helped people save probably hundreds of millions of dollars and in tax. And it's always fun when you get the call, you're explaining the investment and how the appreciation works and how it will affect that and all that. And it's sort of, yeah, okay, good. That sounds good, whatever. But then when you get the call like on April the 20th or sometime soon after they have their tax work done and they have to sit down with their CPA, they're like, wow, this stuff really works. Like, no. And so really through education, I would say through education and building long-term wealth, I think we've delivered a lot of value over the last decade.
Dave, I just want to acknowledge you, man. This has been super fun conversation. I've learned a lot, and I just want to acknowledge you, man, for continuing to add value at scale to so many people and giving people the opportunity to question conventional wisdom in all aspects of their life. Dave Zook, any parting thoughts or words of wisdom that you'd like to share with Elevate Nation today?
No, go question conventional wisdom. Partner with great people. Life is just a whole lot more fun when you do business with really cool people. And so just go out and do that well. Go make an impact your community, your family, people around you.
Awesome, man. Great stuff. Dave, until next time, my friend, thanks again for being on the show.
All right. Thank you, Todd. Thanks for having me.
Elevate Nation, Dave Zook bringing the heat today, bringing so much value. I just love when we get to speak with people as successful as Dave Zook, and you realize how nice they are, how kind they are, how willing they are to share their perspective and sort of help us kind of dive in to identify those clues. And I can tell you there's a lot of clues from this conversation today. And you want to talk about somebody who is bold, who is continuing to push the limits, who's continuing to question conventional wisdom. I can tell you that conventional wisdom in the real estate space is not one of which we can raise $500 million. That is not conventional wisdom in the space. So there is tremendous upside to questioning conventional wisdom. Again, you can be conventional or be wealthy. Pick one. That is such a massive takeaway from this episode, but there's so many more. I want to encourage you to re-listen to the show, because when we listen twice, we learn twice as much. When we listen 3 times, we learn 3 times as much or more, by the way. It's amazing what our brain sort of takes out of the conversation when we're not careful. And when we re-listen, repetition is a mother of all skill. If we want to gain the skill and the expertise and the willingness to open ourselves to new opportunities, I just want to encourage you to do that. I also want to encourage you to share this episode with a friend and have a discussion. I want you to identify your top 3 key takeaways from this episode. There's probably 27 takeaways, to be honest with you, and maybe even more. But I want to encourage you to identify your top 3. What are those 3 items that really moved you? Moved the way that you saw things, the way that you want to communicate with your partners, the way that you're interacting with this market cycle. What are those takeaways that you want to apply immediately? Because ultimately, at the end of the day, application is where the real power is. Knowledge is not power. It is the opportunity to take action on insights, which then creates power. So ultimately, I want to encourage you to take massive action on what you learned today. And until next time, Elevate Nation, thank you so much for tuning in, and we will see you next time.
Thank you for listening to Elevate. If you enjoyed this episode, be sure to rate, review, subscribe, and pay it forward by sharing with a friend. Most importantly, take this opportunity to elevate your results by taking immediate action on what you learned. For more, visit elevatepod.com.